Hey everybody, welcome back to the Bear Trap podcast. My name is John Kirby, my co-host is Vic. All charting credits, as always, go out to Auk. This episode is breaking down Ambrus's recently released paper on 0DTE. Turns out they've been monitoring this stuff. Ambrus, for those of you who don't know, is a volatility fund. Their main goal is to hedge market risks. In other words, they're really interested in trying to figure out how much of the risk there is in 0DTE, and so are we all. And this has been a pretty hotly debated topic. Some people think that 0DTE is just setting the stage for a massive vol event, and other people think that it actually suppresses intraday volatility. Turns out the Ambrus paper sheds a lot of light on this topic and also helps us think about some other things that have been happening lately, like the death of the VIX index, among others. So we just thought, why not get into it? Why not try and look through some of these charts, break it down? And this is just going to be the first of the video because there's so much to unpack here. It was a short paper, but the charts have so much interesting information, and I think a lot of it can actually help you actively in your option trading. So yeah, stay tuned, like and subscribe, and I'll see you guys in the next one.
These false narratives, I don't know, I guess I didn't really think of them as false narratives, but to just kind of throw that out there right away.
I mean, I think with any sort of paper like this, right, like the way that you format it is you pick a straw man, right,
Yeah.
An opponent, and it's like a publicity thing, right? Like, and so it's like that assumption of, oh, everybody's thinking that people are just YOLOing 0DTE, SPYs, and SPX, when the reality is, like, we had a pretty decent understanding all along that there's no way that, like, retail is trading this type of size anyway.
Right. Yep.
And then
there was some good stuff in there. So.
Oh yeah,
really interesting tidbits.
And then the other thing though, like I want to mention is that like maybe I'll do it like this, right? Like, and say that the main point of the whole article, and Vic, correct me if I'm wrong or if you read something else, is that, or like the false narrative that they're trying to beat down is this idea that people are buying 0DTE options, or that's most of the trading that's going on. And the reality is that most of what's been happening has been selling of 0DTE options, especially by larger players, and that's been a way to make returns throughout the bear market and in this sort of higher yield environment where equities seem a little more dangerous.
I mean, you summarized basically their conclusion, right? Was that and so anyways, the whole point of the paper, I think, was just to say, like, look, like you said, the volumes just cannot be substantiated to being retail, just YOLO. Zero, because whenever you hear zero DTE, I instantly just go, yeah, we're just YOLOing, right? It's just lottos. That's all I ever think of. But to think that it's actually these funds coming in here and just basically selling the edges, I guess. And I mean, saw somewhere they're selling basically strangles here into the market.
Yeah, let me actually,
because I thought that was interesting.
We can get some of the details here. I'll like expand it, and then is this too expanded?
I thought that was interesting. Like, wow, they don't even care. They're just kind of coming in here and just going, yeah, premiums are just gonna be jacked at the open. Just sell everything.
Yeah, I'm trying to find exactly the part where oh, here we go. This is what I was looking for. That's why it makes sense to be zoomed in. So they have these charts, mean 0DTE volume imbalance by strike and time. And so you can see, I think, yeah, so green is buys and red is sells, right? So this is the beginning of the day, 9:30, and we're seeing all these sells come through. And for those of you guys who aren't familiar, like moneyness is essentially like delta, where moneyness would be, right, if it's 100 moneyness, then it's at the money, I think, and then if it's above 100 moneyness, then it's in the money by some amount. It's like it's calculated as a percentage of, like, that strike as a percentage of spot, basically. And we're not going to, it's no point getting into the actual math because it's not that interesting. But the point is that this is your 50 delta, and then this is your in the money, and this is your out of the money, both for puts and calls here. So basically this graph is looking at, irrespective of puts and calls, in the money option versus out of the money option selling, and then buying.
So it was selling in the mornings and then speculative directional bets in the afternoon, right?
Mm-hmm. And it's really cool how like nothing happens in this dead zone, which we've been recognizing. Hey, like that time from 11 to around 1 p.m. Like if you're holding options during that period, and I learned this the hard way a couple of times, you get burned up. You get burned up so bad.
Yeah, you saw that on Friday, as a matter of fact. I mean, that was painful trying to trade that chop in the afternoon before it finally made its final move to the destination of 4170, which you kind of knew it was going there, but it took like 3 hours
100%
to go like 10 points, you know.
I got chopped up in that actually as well.
I did too. I got massacred in that. And it's just going against the rules. I already know I shouldn't be trading basically like 4 of the hours every day. I shouldn't even be touching the market and just waiting. But anyways, you see it right here. It's in the data that, yeah, I mean, there's just nobody doing anything until you get till that after lunch period, and then they start in.
And the reason from a sort of options Greeks perspective is if people are coming in and they're selling a ton of options earlier in the day, and then they're dynamically hedging those option sells, and most of those option sells are towards the tails, that's actually going to stabilize the market. So at first, as they get into positions, right, in this these first 15 minutes or whatever, maybe even until 10:30 here, as they're still selling options, you're going to find that imbalance, which is going to be, market's going to be rocking back and forth. But what'll happen, especially as the theta starts to kick in, is that the fact of those options decaying is actually going to stabilize the market. So a lot of people attribute the midday lull to like, oh, they're having lunch over there, on Wall Street, everybody's out to lunch. And I don't know if that's true. It may be. It definitely used to be true. Now that is definitely being reinforced by the fact that all these options are decaying, and as these options are decaying, it actually siphons us in or keeps us in a narrower range.
Everybody's out at lunch. I mean, there probably is people out to lunch, but their algos are trading. So if you were smart, then you would set your algo to trade when there's volume back in the market. And so I just think the algos are just not trading. It's just the scalp ones that are trading. Anything buying any kind of SPX option is not doing anything until participants are back into the market, because otherwise, you just sit there and there's nothing happening. But this leads to this low vol, right? Like you saw a 15 print on VIX on a weekly close, on a monthly close, mind you.
Yep.
I mean, that was crazy. I've been saying VIX to like 3, just kind of joking around. But it's like, if this is what the trend is, I would not be surprised, okay, if I saw sub 10 VIX. I know it sounds crazy, and I don't have anything to back this up, but it's like the amount of put buying and insurance that's happening over like the next month or so. It's like, yeah, I mean, these people are going to get destroyed. And then with this new, basically vol selling that's happening every day, or really it's theta is what they were talking about, being the fact that it's 0 DTE, like taking advantage of the theta. But it just kills volatility.
Yeah. And so you can see that they're actually obeying that trend. So even, this is a really cool chart too, right? This is greater than a 1% down day. And then what they call volume imbalance, which is just like how much people are buying versus selling those strikes and stuff like that. Same thing, right? But the point is that buys don't actually start coming in until after the afternoon. So even on a down day where the market's like crashing, or maybe not crashing, but it's definitely falling, people aren't actually hedging until later in the day, because those hedges aren't worth it early in the day, which is kind of interesting. And then you see this really interesting, look at this pocket here. Like you can tell this is basically people selling slightly out of the money. So it's like people are still trying to sell a strangle. Obviously it's way less than here, but There's still a pocket of, I would assume this is actually like this looks to me like the 45 Delta Strangle or something like that. That's interesting. So I guess they like selling that for some reason.
Yeah, that is really interesting actually, and the timing there is what I'm concerned about, because like a lot of times you wait for this initial balance, and it's about the 30-minute. That's when that comes in, and a lot of times you'll see that move. The opening move, it's really garbage, and then you got something happens at about 45, and then something kicks on at 9 o'clock or 10 o'clock market time. And that happens right there, dude, right where that dot is right at 10 o'clock.
Yep.
So something kicks on at 10 o'clock every day. You'll see it. A lot of times I'll be like, well, I'm just going to wait till this 10 o'clock hits and see what that move is, because that'll be a reversal time. And then at 10:30 again, there's usually
Well,
a reversal.
I can tell you what that is, Vic, actually. I mean, I don't know what this particular dot is, but the movement that we usually see at 10 o'clock is because the first half hour of the day is basically orders coming in. And a lot of times there's a lot of market makers that actually don't kick on their real quotes until after the initial balance is settled. And so they don't actually start hedging stuff out until 10 a lot of times, because they basically, it's like what you do is you accumulate inventory for that first half hour, and then after that half hour is over, you figure out how to price things and how to distribute it.
Gotcha. Okay.
Yeah, well, that's like it's a rough way of phrasing it, but it is, and it's not all market makers. So I'm making a statement that is like generally true, but it has lots of conditions.
No, it's another factor, I would think, then, if that's the case. I mean, that may be what, because it's the same thing. You follow a theme, right? We got, they know that Citadel is just waiting on their hands until 9 o'clock, 10 o'clock, because they just want to accumulate the inventory and figure out how to distribute it or buy more,
Yep.
But they're waiting 30 minutes. So then all the smaller guys are just like, well, let's just wait till Citadel's, see what they do until they kick their algo on. And then we go to lunch, So, and it makes so much sense how to think about it, because there's only so much volume in the market. There's only so much volume. There's only so much inventory to kick around. And so, and right now, especially, it's low volume. It's low volume. Everybody's in the options market. Everybody's selling premium at this point. And it just makes so much sense, especially in hindsight, why this action is the way it is.
Yeah.
And does it continue?
Yeah. And why it suppresses vol in the same way that it does. And like eventually, I mean, maybe later in the call, we can get into some of the Vanna stuff, which is interesting, because I think the Vanna stuff is actually the key to understanding when the pin breaks, so to speak.
You mean the overall pin, or just the pin during the day?
No, the overall pin, not even
during the day. Yep.
But we'll come back to it. Anyway, I want to take a look at this too. Okay, let's see on an up day. On an up day, they're not waiting as much and we can compare it. I'll scroll back there so you guys can see on a down day, it looked like the volume really started to come in at like 110, and it's like a pretty clear delineation there. It looks to me here like we're getting kind of a spattering of earlier volume on the 1% up day.
Mm-hmm.
And it makes sense, because typically, right, like out of the money calls are significantly cheaper than out of the money puts.
Mm-hmm.
So you can deal with more. You can be wrong for longer holding a call because you're not. Yeah.
Think about it too. If these big funds predominantly are selling by volume, anyways, are net sellers, and nothing happens by lunchtime, then why would you go out and buy more puts? Because effectively all you're trying to do is just hedge. In general, you're buying puts just to hedge your long positions in general. And so if nothing has happened, then why? It doesn't make sense to go buy puts.
Yeah.
It's just to your point. It just makes more sense to just be in calls. They're cheaper. You can hold them longer. And then again, there's no reason to hedge. Nothing's happened.
Yeah, and even if this is a sort of an isolated strategy, which is only playing options, which they get into later in the paper, right? Which is that there are a lot of like even private, forget what they call them. They have a breakdown of. I'll get into this. Also, sorry for the scrolling through Oh, here we go. This is what I wanted. It's just that it's easier for us for like seeing the charts, even though it's harder to read the text. But I was trying to talk about these volatility hedge funds that they're talking about, or even these wealth advisors systematically generating yield, or whether it's speculative trading and hedging. So I mean, these people, like, even if you're not necessarily protecting a portfolio of long equity as part of your activity, right? Even if it's a completely separate protocol, it doesn't really matter, because you know that the structure of volatility, or market structure, and also the volatility skew, has a tendency to squeeze the puts more than the calls. Meaning that if we're at midday and nothing happens, the hand of the market, so to speak, has already been tipped.
Right. Yeah. I mean, the edge is already built in to just structurally, it's built in to go up. And especially think about this last week. Okay. We had tech earnings, some big boys reported. And I think people were thinking that the bad earnings was going to cause the market to go down. And I feel like in general, the market was positioned to the downside. So you had GDP come in, and then you had PCE come in. Effectively, it was all bad from what I saw. Okay. And the market ended up closing higher on the week. And the VIX ended up closing below 16 on the month. And you had SPX closing. If you look at SPX daily or even weekly, it actually it looks pretty stinking bullish. I know that we're in this situation where you got the whole market thinking this is the complacency period right before the big one, right? And in the chart looks like everything's lining up for that, and it's really fascinating to see it. But it's just like, man, how can you be bearish yet? You can be bearish maybe longer out, but then everybody else is probably thinking the same thing. You know what I mean? Like, I can't be the only one thinking this. I mean, there's got to be other people that are like, and so my whole point is, like, how can you short this market right now? How? This is what I want.
No, I mean, you can't short anything that looks like that, just off of pure, like, stupid chartism.
I mean, it's nuts. And so yeah, get rid of that VIX real quick.
Yeah.
And if it's just basic chart pattern, you basically have a cup and handle forming on the daily.
Yep.
Okay, well, all right. So we are I saw somebody say this was a megaphone starting. It's possible. It looks like a cup and handle to me, but I was like, I can't understand. Now, Jay Powell coming on Wednesday. Is he going to raise rates or whatever? That's the next question.
Well, I mean, if we're gonna get a top, it's gonna be a blow off top. So sure as heck, that top's not gonna be 4169.49, right?
Exactly. Okay, then you got to think, well, there wasn't that much volume. You had a strong close. The trend is what? Now that we've read this paper, we know what the trend is on SPX, anyways. And so at this point, these guys all get blown up, right?
Eventually, yeah, it's complicated for it to happen, and that's, I mean, that's a completely. I was having that discussion with Auk as well, where, like, Ambrus is pretty clear, and I think they're right. And what we're seeing in these, I'm going to go back to making this paper the full view, but what we're seeing over here is consistent with that, which is that this in general is quite suppressive of volatility intraday. And a lot of the problem is that whenever we have news, like if you have news that comes out, and think about this, like think about the structure of catalysts, right? How many catalysts do we have that happen in this dead zone between 10:30 and 12:30?
Not many.
Because this is the vulnerable zone. This is where technically everybody has sold premium and is sitting on their hands waiting for that theta to expire. If the market had to crash, it would have to start here.
That's such a good point, actually. That's such a good point, because they did talk about that cascading effect, right? Where, because of this, it's not affecting the markets that much, other than just suppressing vol. But if there was to be a sigma event, right? That the tail risk, But the timing, that's so interesting to be in the dead zone. That's when it would happen.
Yeah, because you have a
Man.
really big issue, which is that, all right, if it happens pre-market, then everybody's going to adjust their positioning and sell vol at the appropriate price or at the appropriate moneyness in this period here, and that's going to suppress vol. So it doesn't matter what happens pre-market. If it happens later in the day, and actually let me go to a 1% down day here. If it happens later in the day and it happens anytime after 1:30, people are already in puts. People are already long gamma, right?
Right.
If you're long gamma, you don't have that crash risk.
Yeah.
So the only time we could really generate a cascade effect in a crash would be if we were to get a catalyst right in the dead zone, which, think about it, most news doesn't come out in the dead zone. None of the official events, none
it
of
would
the
have to be
FOMC.
something that's not pre-planned. It has to be something just out of the blue. Because I think I hold the assumption that most news is like vetted, okay, and pre-planned to release, right? Like they know when they're going to release it, and to get the tail risk event, like you're saying, yeah, it would have to be something in that zone potentially and out of the blue.
Yeah. I've seen a couple, I remember a couple of moments. I remember one very specific rocket that hit a Ukrainian drone at 1:03 p.m. It was in the last month, I think, or maybe the month before. I don't know. The time kind of mashes together. And I remember just like a massive sell-off coming in, and then you see that sort of, you can see this pretty clearly if you look at order flow. It's not so much like you get a perfect V-shaped reversal. It's more like you get it's like it comes down, right? And then it just bottoms out, and then it just turns into like a little bit, it like springs back a little bit, just hangs out for a little bit, and then slowly creeps its way right back up to where it was initially.
Yep.
And I think when you see something like that, that to me is indicative of people saw, like option sellers essentially, they had it fall down, and then as it was coming down, they took advantage of the higher implied vol to continue selling because they know that everybody else is doing it. And so in this particular case, even though it happened right at the tail end of the dead zone, it still was suppressed. And I mean, that part of that might have to do with the seasonality component. Where were we in the month? What was the overall gamma structure, landscape of gamma exposure at that particular time? And there's a lot of variables here. But all I'm saying is, the only point I want to make is, not only does it have to happen in the dead zone, but it has to be more severe than a rocket hitting a Ukrainian drone.
Well, I remember, so I like that point you just made there, is it has to be more severe than a rocket hitting a drone. And I remember there being nuclear threats and the market going higher. Okay, you got Vladimir Putin, which is saying he's going to bomb something with the Duke. I don't care what it is. You know, in a normal market, that would cause some fear. And nobody's scared of anything right now. What's going to come out of left field is it's going to blow our imaginations. Like, we just have no idea what it could be. And it doesn't make any sense to speculate either. I think that's what they're thinking too. Everybody's just going, well, what else could it be besides like a meteor like taking out New York? Because what else could possibly stop this machine that's going on right now?
Well, what else gets you a Sharp of 1.67?
Yeah, well, the only thing is Jay Powell coming out here and going, guys, we got to get inflation to 2%. I don't know what you guys are doing out here. And I don't know if you keep seeing my Twitter here, but I keep talking about this Binance coin, BNB being 50 billion market cap. And that's not, I just picked that one out of the top 10 because all of them are, you got the top 10 cryptos, which are multiples more valuable than some really nice companies, actual stock, and that just speaks volumes to me that the Fed is still just humming along, man. Like everything's normal.
Yeah.
There's no volatility because the Fed is there, propping everything up with whatever it's doing. I don't know what they're doing to prop it up, but there's just no fear because there's nothing to be scared of. It's all taken care of, man. The Band-Aid has been on everything. And so, yeah, here's the play right here. Just come in the market every day and just sell some puts.
Well, it's funny.
In the
I was
morning.
talking to Tux about this, and like that was way back over the summer. I know this is kind of a stupid thing to say, but like the strategy that I had, because I had a very particular gamma-based strategy for predicting the closing price, and instead of buying vol, my whole idea was actually to sell an at the money straddle at the open.
Of whatever closing strike you thought it was going to be.
I remember us talking about this and then hedging it intraday by buying the tails at once some of the theta had already decayed.
Right.
And it was a beautiful, beautiful strategy, very difficult to execute, but turns out, hey, a ton of people have been executing it the whole time.
Same kind of thing, yeah.
Yeah.
Well, you think, okay, we're special here. Okay, we got gamma charts and we can predict the close and all this stuff. Well, dude, I think they've been doing this for years. I don't think this is anything special. Okay, we just now figured it out, and so yeah, I mean, you basically hopped on the bandwagon. You didn't realize it.
Yeah, that's true.
Because that's the carry trade right there, is coming in every day and just
is
literally milking the IV.
Dude, that's the new way to put it. This is the new carry trade. That's what's going on.
Well, it is. I mean, and Jeb talks about it all the time. Is like what happened before Volmageddon or whatever it is. And I'm not an expert in that area, but he always talks about it. And he says everybody was selling vol. It was a crowded trade. And it kept working. Hedge funds were making money. Others that weren't doing it weren't making that much money. And it was like, so everybody had to do it. Otherwise, you're just out of the game. And once everybody was in the corner together, what happened? Vol went crazy and exploded. I sort of see this happening now in my own brain. Like I was telling you the other day, sometimes I can't explain what I see as well as I understand it in my head. But everybody's moving to this trade. And what are they doing in the long-term structure with options? That's shifted.
We have some very convenient charts to help us interpret that as well. Do you have a preference between delta, gamma, vega?
I don't care, man.
All right. Well,
I don't have a preference for any of them.
Okay. Well,
let's just go. Let's talk gamma.
Gamma. Okay. Gamma, simplest one, the one that we've been observing, and the reason that we keep using gamma exposure in order to figure out market direction, and that is that gamma by far predominates for 0DTE.
Sure. Yeah. But the trend of the long term, though, I mean, you can see it's sort of going down, and this kind of like what I'm saying is I think of it as this trade, this predominant like meta of trades, which is the carry trade. Once it's sufficiently shifted over to where everybody's just basically effectively trading 0DTE for their carry trade in a sense, then it's really exposed.
Well, yeah, and I mean we're getting there, right? Like, because even if you're thinking, oh hey, 1 to 7 DTE is coming up just a little bit here as a proportion of 0 DTE, and remember this is a chart which is displaying different percentages, right, of each of these. You can see 0 DTE is actually still coming up even more. So
the ratio there is definitely changing, and the 1 to 7 is going down. I mean, relative to last May, so 2 years ago, and all the others are coming down. As a percentage. So
to be fair, right, this is in terms of gamma. So basically, what they're doing is they're just taking a Greek, multiplying it by the volume. Again, roughly, this is not precise, but taking a Greek, multiplying it by the volume transacted.
Right. A fraction of the total volume is coming from this.
Exactly. But of course, because gamma is as a Greek is so heavily weighted towards the present, towards the to the front months, to the back months. Sorry, that's confusing terminology. Towards the present, let's just use that. Then that's why you see this disparity. But the whole point is here that the volume in 0DTE is rising relative to volume in other expiries.
You see that in the delta too.
Yeah, you can see in the delta too. Delta is like slightly more complicated because you can see, well, it's kind of fun. You can see the 1 to 7 DTs actually coming up a little bit. So people are starting to trade shorter in general.
Starting, yeah, they're starting. They've been doing it for a year steadily.
Okay.
It looked like it was like last May is when the trend sort of shifted here, where it took another leg down for the 1 to 6, another leg down for the 8 to 31. The 1 to 7 has been flat for a year, and then the 0, obviously that one spiked when we went to Tuesday and Thursdays.
Yeah. Oh, that's a really good point. I forgot about that. You're right. Yeah.
But the delta didn't change that much as a percentage of the volume. I'm not savvy enough to figure out why that would be, but
yeah, there also is an issue with this chart, right? Because if you think about it, the density for a certain portion of the chart, the density of options like on a per day was different, right? So for instance, like earlier in the year, if you're talking about options that are 1 to 6 months out, you're not talking about a set of as many options as later in the year.
True. Very good point.
I don't know if they normalized for that. That's something that, Ambrus does not tell us.
I think the data as it is good enough to give you the picture. So whether they did or not, it's not that.
Yeah, I'm just a nerd, man. I just like.
No, I know, but I'm just saying that the point is we see the shift in the data now from basically whatever structure of trades. Like you always think of this JPM collar trade, and I'm sure there's all kinds of other funds that do that kind of stuff. They're just the one that everybody knows because it's probably the biggest. But it's like those carry trades that they just do all the time. Well, those are starting to change, right? A fund that was maybe doing a quarterly carry trade like that is now doing 1 to 7 days. Who knows, right? And so that they may be shifting the underlying foundation of the market is changing.
Well, I think they are. I mean, if I were leading a volatility fund that were doing something like that, what I would do in order to distribute my risk, even if the yield isn't as good from those 2 to 7 DTE options, I'm definitely going to take advantage of multiple standard deviation moves on a daily basis to reposition myself across further expiries. In other words, like I'll be taking advantage of abnormal movement in spot and in the term structure so that I'm actually shorting volatility in a way that's like more consistent across expiries. So I'm not too, but I'm sure some of them are doing that.
Yeah, well, okay, so you see my point is that is going to change. It's going to change what all the players are doing, and we already see that. So that's interesting. So maybe once the landscape has shifted enough to this, the short-term type thinking and trading, maybe that might be the time when it unpins itself.
Yeah, because
but who knows how long it could take.
Like hedging in later expiries is going to become too cheap. So you're going to want to do it. You'll sell vol today and hedge it in tomorrow, which is going to make vol tomorrow more expensive. So then you're going to sell it tomorrow and then hedge it in the next day. And then all of a sudden, slowly we build back to a term structure that more resembles a term structure that makes sense.
Yeah. It'll shift back to the other side, or it'll take a catalyst to sort of just shock the system until we go back to playing the normal game, so to speak. So
look at this one, because this is the nice segue into the stuff that you've been thinking about.
Sure, yeah.
And then the reason I think it is because you can see that the Vega volume by tenor is still 1 to 6 months to expiry. And the reason that that's important is, like if you're hedging because you want to capture an expansion in implied volatility, your best bet is still contracts that are 1 to 6 months out. And that makes sense because Vega, while with some of these other Greeks, they're inversely proportional to time. In other words, like they're not purely inversely proportional to time. This is going to be really annoying, but like technically, if you have 0 time, your gamma doesn't go to infinity, it goes to 0. But that aside, they're inversely proportional to time. In other words, the further out you go, the less your gamma is worth. Delta is a little different, which is why the delta chart looks different as well. But Vega is one of those which is very different, in which hypothetically, right, if you get a vol event and you're holding puts that are 1 to 2 to 3 months out, those puts are going to benefit a lot because volatility begets more volatility. And so it rises the term structure whenever you have a vol event. Every single month along the term structure rises. And in fact, as a proportion of the vol that was already in those months, they rise substantially.
I wonder if this is the 1 to 6 months is interesting. I'd like to break that out. Is it actually weighted more towards 1 to 3 months versus 3 to 6 months? Because that sort of captures just the quarterly trade. In my opinion.
Yep.
And so I think people are just, we got a couple guys in the Discord that just they play quarterlies and they just buy puts the whole way up. Or whatever their trade is. But, it just sort of reminds me of that a little bit of like, you can just go buy the quarterlies for your insurance.
Mm-hmm.
And then this is what happens is no vol event comes, another quarter passes, and then we just rise into the end of the quarter again. And, sort of like what happened, every dip gets bought because the dealers are going to be short in their deltas and they need to buy them back. And then the game goes on again and the cycle begins again.
Yeah. I mean, that would be a really nice play, essentially selling 0 DTE vol and then covering your ass with monthly or quarterly vol.
I bet you. So this is what happens, I think, is once this window starts coming through again near the end of the quarters and stuff, and maybe even end the months, there's probably small versions of this, but that's when the real vol selling starts to happen on SPX intraday. I bet you the volume ticks up. I'd like to see that, because if you know that the dealers are going to need to be buying their deltas back, then you literally could come in every day and potentially just short, sell the put 1% out, 2% out, and it's like almost guaranteed free money.
Yep. Yeah. Well, because if you get a move, right, that is more than that 1%, then essentially you're getting a guaranteed Volmageddon type move, which is going to increase the value of your longer term puts by so much that you'll be fine.
So you could potentially position yourself along this quarterly structure or whatever time period you want to take in the Vega side of things and be okay, like no matter what happens. If you sell the put 1% out and you get a 2% move, well, then you sell the puts that you had, because those are going to go crazy, the ones that you have for the quarter or the month or whatever.
Yeah, although it should be said, Vic, like don't for those of you at home, this is not financial advice, and don't go out and do this.
We have no disclaimer, official legal disclaimer. Okay, so don't sue us, bro. Okay.
Well, okay, I was gonna say something else too, which is like, in order to do something like this, you need portfolio margin, right? Like you need to be able to cross margin your short exposure in the quarterly against your short gamma exposure.
Right, you're gonna need a nice size amount of capital to be able to do this kind of stuff. But which is I'm talking in general about what maybe speculating what the funds are doing.
Yes. Yeah.
I can't even do that. I couldn't come sell a naked SPX, but that's not within my realm of capabilities. But you may be able to come out and sell a SPY. It's the same thing. But it's like, is it really worth it then? I mean, you're going to sell what, a $20 contract?
No, you need, I was tweeting about this too. And it's like, if you're going to be in the vol selling game, then what you need more than anything else is a massive amount of capital, so that when something goes against you, you can sell more vol and keep selling more vol until all of a sudden you're no longer red and you're in the green.
So you're essentially saying, and this is like 100% guaranteed strategy, is if you have enough money, you can continue buying the dip until it turns around.
Yeah, exactly. Right. That's what the Fed does.
Yeah, well, it's the same thing. I remember I was messing around with just when I first started trading futures, and I was just like, man, I'm just killing it, because I had no limit to what I could buy, and so I would find the low eventually, and who knows, sometimes I'd be in it for 100 contracts or 200 contracts, but eventually I hit the low and it turned around and then you made money, right?
Yep.
It's the same kind of thing. If you got a ton of capital, then yeah, you can obviously just keep selling vol until it turns around, or buying the dip until it turns around. But you're saying it's way riskier. to do
well, you need
to be naked.
You need to
in
have
these
a model that
positions.
you need a model that can tell you when shit hits the fan, how much is going to hit the fan and how much is the fan going to break.